Well, it did during our civil service meeting.
There it is.
Yep, there it goes.
1:30. Work. I mean, thank you. I didn't say that. You said.
Just in case he gets.
We're all here for you, man.
Hey, Lisa.
Hey, Finley, are you able to attend our meeting now?
Yes, ma'am. I just got home.
Okay. We're fixing to call it to order then. I would note that, all members are present with the exception of Finley, who is attending virtually. And we have our city attorney, Charles Binkenbinder here, and Cody Arnold in the HR department. Also, we have Pat Boone. The minutes of the September 7th meeting were distributed via email prior to our meeting. I would entertain a motion to approve those. So moved.
Sir.
All in favor? Aye.
Alright.
Okay, motion carries. Before we get to our other business, I am going to turn the meeting over to Pat Moon with Meridian Investments. He's going to present a quarterly report to us.
Very good, thank you. Well, I think a good place to start would be on page 1. I'll spend just a brief amount of time talking about these first 3 pages because we have something at the end I'd rather spend a little bit more time on. But and just talking about the economy, it's broadening, things are getting better. I'm showing that in these charts here. The economy's growing, it has grown back to about where it should have been if we hadn't gone through the recession last year. And it got back much quicker. You can see it compares the recession back in 2008, and it took a number of years to get back to where it was, and now we've done a little over 12 months, and that's good. The growth rate's probably going to slow a little bit from now going forward, especially this next quarter. And the things that are returning to good are retail and food service sales. You can see up from July of last year, tremendous growth and rebound there. And then new filings for jobless benefits continues to go down. I read this morning where in September, 4 million people left their job. We lost 22 million, and we gained about 11 or 12 million of those back. But 4 million people left their job last month. We don't know exactly why that is. It's probably some related to the virus and the COVID virus. Because it happened a lot in the retail environment, and restaurants are struggling to keep people working in the hospitality and those things. Maybe they're leaving for other jobs, maybe we just don't know, but it's hard to get back all the jobs and get people back to work if we have 4 million people quitting their jobs in one year. And they're quitting their jobs to do something. They're not just quitting to draw unemployment. They're seeking other, maybe in most cases, better jobs. So it may take a while at that pace for us to get back to full employment. On page 2, a really big story right now is inflation. And where you see that the most is at the grocery store and the gas station. A gallon of gas now is well over $3. And we've had this debate about, well, is it just transitory, or we just having this big inflation, then it's going to go? It's looking like it's lasting long. So this shipping problem, this logistics problems we have to come from other countries, is going to be with us for quite some time. All types of commodity prices are way up. So inflation has really returned. This measure shows you this spike in this top chart. That excludes food and energy. So that's which are the most volatile components. They do that to kind of get at what's going on in the rest of the economy. We've got 3.5% rate of inflation. With that, we probably put in the 5% range. And I put that on there because it's the enemy of bonds. With inflation going up, interest rates have to go up, and the prices of bonds go down. So I just wanted to note there, as I've done in the past, that bond returns are going to be pretty low probably going forward. We've seen an increase in the interest rate. So the bottom of the chart, the orange or reddish line is the interest rate on a 10-year Treasury note. It was 1.3% at the end of September. It's currently about 1.6%. With inflation running at an annualized basis of 2.3%, you're actually losing 1% in purchasing power on bonds today. That's not a good thing for pension planning. And lastly, on page 3, we'll talk about stocks. This is the 17th best start to a year for stocks. It's kind of interesting in that it's gone up for the 6th straight quarter in spite of the market going down 4.8% in September. That's just 3 different markets. S&P 500, large company stocks, NASDAQ, a lot of companies, technology, and the Dow, which is 30 kind of large companies we would all know. So this shows the top 20 starts on the top right, and we're number 17 there. And I just want to show you returns of the last 4 months of the year following these 20 has averaged 4.5%, and for all years it's averaged 3.2%. So, that would tell us that generally it's pretty good, but you'll notice there are some negatives in there sprinkled out. So maybe not. The market actually is down for the month of September and the month of October, month to date, a little bit. Not a lot, but a little bit. Well, let's turn to page 4 to your plan and show the 12-month cash flow on the right, growing from 13 million to 15.7 million, which is actually just a small decrease than where it was this time last time because the fund declined a little bit in the quarter. It was down 1.1% per quarter, still up almost 8% year to date due to 1, 3, 5, and 10-year annualized returns there. Point out a couple things. One is the bonds. You can see there, as I would tell you, it's little to no return. We've got a very small gain where the market's very small loss, but we're going to see some more of that probably, either little to no gain or even losses of bonds when we look at another year or two. So we're keeping that as a pretty small portion of the fund. And then I changed this chart up on the bottom for a reason this time. I'm showing you more data points. Your stocks is the purple bar. And then I'm showing you, instead of S&P 500, which is orange, and international stocks, which is red, I'm also showing you small company U.S. stocks in yellow and blue. I'm showing you emerging markets, foreign stocks. And the reason I want to do that is to have a conversation about why we are invested the way we are. But for the quarter, you can see the S&P 500 was really the only thing that was up. All the other markets were down for the quarter. Year to date, your stocks are up 11, S&P's up 15.9, international stocks up 8.3. The star performer over the last year has been small company stocks, up 12% year to date and up almost 50% over the last 12 months, where your stocks are up about 30. The reason I'm showing you this is because I want to talk about asset allocation, and I'd like to remind you about why we are invested the way we are today, so that you're familiar with it and comfortable with it. But if you go to page 5, let me show you where you are today, and then I want to make some comments about that. So the pie chart, as you know, that's everything. That means what kind of risk and return you're going to get. You're at 20% bonds, which is at the very low end, and you're at almost the top end of stocks there. So still being pretty aggressive in the portfolio, and stocks should provide a much better return than bonds going forward. And on the bottom, you can see we did make some changes. We're not quite as active right now because the market's kind of flattish. If we were to pull back some, we'd be a lot more active. But we did sell 4 stocks during the quarter. 2 that we got tired of waiting on doing better, LendingTree and Teladoc, and 2 that have done very, very well, Honeywell and Starbucks. So we sold all 4 of those positions. Starbucks, everybody's familiar with that. I'm not a $10 coffee cup drinker. I'm a Folgers kind of drinker. I'm not really qualified to talk about it, but their stock is really, really expensive for what they do. So we made some money on that. We decided to move on there. And then we bought Fiserv, which is bank software, and Etsy. Anybody here familiar with Etsy? Okay. Mostly, I don't want to say mostly women, but it has been up to this point, and they're really broadening out into other things, home goods, crafts and arts and things like that. So we took a very small position on that. Well, let's talk, if you don't mind, then on page 6 about some thoughts about why we're structured the way we are, why we're thinking the way that we are. And this isn't unique to Meridian. This is just kind of the money management business. I've shown you in the past this chart at the top, which is the return ranked in order from top to bottom in each year of these different asset classes. So in 2001, fixed income or bonds at the top left there was the best performing asset class. And then cash would have been next. That means the stock market was not doing very well with cash, and bonds did the best. Small cap stocks, then a dividend portfolio, which was large company stocks, large cap value, and core and growth. Those are all kind of S&P 500, and then international stocks down the bottom. So I've shown you this for a couple reasons. One, if you just kind of look at the colors, don't really pay attention to the data. There's not really much, there's no pattern there. You can't say this is going to happen based on this period of time, whatever. It can be pretty random, but there are periods of time where certain asset classes do better for a period of time. And I wanted to point out to you, your stocks have done really well recently, and they also had a period where international stocks did really well from 2002, really 2003, through 2009. You can see the yellow box there, and then how well they did. They were among the top asset class really for 1, 2, 3, 4, 5, 6 of those 8 years. And then at that time, large companies, so if you just look at the orange box, not the cash, but the true orange box, large cap growth stocks, or the pink, you can see they outperformed U.S. stocks for a period of almost 10 years, really probably closer to 12. And there's been just the opposite since that time. It's been really unusual for U.S. stocks to continue to do as well as they have. You can see from 2015, really 2013 on that orange box is near the top in almost every single year, and the yellow is close to the bottom. So as a money manager, we diversify just because we don't know in any given time which one's going to do better. And I just wanted to show you the performance of these asset classes, and one that's diversified among all of them. So this chart on the bottom left is a little bit busy, but I'm showing you the purple line. You can kind of zero in on that. If anybody's colorblind, I apologize, but there's no other way to do it but colors. The purple line there actually was one of the better performing for the first from 2000 all the way to 2012, and still is one of the better performing of the asset class. It shows the $100,000 grew to what amount there in that first column of this black table here. So the purple line, $100,000 grew to $386,000, where large cap value stocks did less, fixed income of course less, international quite a bit less, and then small cap the best over that period of time. And it shows you the average annual return of a diversified portfolio, which includes bonds, stocks, small, international, is more than some stocks, almost as much as large cap core, and where the average diversified return there was 7% a year over that period of time, and large company stocks were really just 7.5 to 8. So, and I wanted to show you the standard deviation. So that's the measure of risk. How volatile is it? If you have a higher standard deviation, it's moving up and down quite a bit more. Where the standard deviation of the diversified portfolio was 10, the stocks were 15. That was 50% more volatility, both up and down. So you're getting almost the same rate of return as an all stock portfolio without taking on the volatility, which is measured as risk in our business. Any questions about that? Well, this chart on page 7 demonstrates that even more. It shows how diversification can feel disappointing, especially when the stock market's going up all the time. You're thinking, well, I wish we had more of that, although you've had a lot of stocks. This chart's called an S&P 500 NV. It's returns of the S&P 500 index from 2000 to 2020. And it shows you the big up years and the big down years. So between 2000 and 2002, the stock market, the S&P 500, went down 40%. That was the end of the dot-com bubble, if you ever thought about that or remember that or read about it or whatever, where a diversified portfolio was down 17%.
And then you can see stocks are up 82% from 03 to 07 and diversified 80%. So you can see how all that goes down through there. So generally speaking, it doesn't go down as much and didn't go up as much as S&P 500. But the growth of $100,000 versus this one index, you actually made more money in a diversified portfolio than you did all in stocks during that time, with about half the volatility. So it's a good example of a long period of time where you had three down markets, 2000, 2008, 2009, and then 2020 last year. And that's why you have a diversified portfolio over a really long period of time. You might not have been feeling bad. It makes me feel bad when the market's down, but that's a good example of why we do what we're doing. And international stocks, you've had international stocks in your portfolio the entire relationship with Iridium. Right now, we're kind of toward the upper end of that range. You say, why bother with that when the U.S. stocks are doing so much better? And this shows at the top, the years since 1970, when the orange bar is up, that means international stocks are doing better. And when the yellow is when U.S. stocks outperform. So I know there's negative, but that's the amount of outperformance for yellow there. So look at on the far right where U.S. stocks have done so much better recently, and there have been long stretches of periods, and I showed you 2000 where international stocks did better. This is the point I want to make. If I looked out at the market today, I would say we're probably going to have lower rates of return the next 10 years than we've had over the last 10. One, we know bonds are not going to earn very much money. And two, the stock market has been on a 12-year bull market. It's just not likely that we've never gone 12 years before. It's not likely we're certainly going to go down 12. I think returns could be more muted. And so this at the bottom shows that when the U.S. returns were a certain percentage, what performed best? Well, when U.S. returns during this whole period were less than 4%, international stocks outperformed 100% of the time, 45 years, 45 over 45. When U.S. returns were less than 6%, international stocks outperformed 94% of the time. And if you look at all of those, U.S. stocks have outperformed just a little bit more than international. So just not knowing when that's going to turn exactly, I just think that we're going to benefit from that, from diversification going forward. When U.S. stocks maybe are not doing quite so well. So you've had a lesson in ordering investments 101.
So you're not suggesting to put everything in stocks.
I am not.
Or in
Specifically U.S. stocks.
Or in U.S.
Specifically U.S. stocks. You can see we have about a third of the fund in foreign stocks. I do think stocks is about the only, you gotta kind of be willing to take a little bit more risk right now. You gotta have more stocks because the alternative is so bad of being bonds.
And if bonds, we wouldn't want to reduce the amount of bonds we have to less than 20%.
Well, that investment policy that we have is based on regardless of what the outlook for the market is. It's 80 to 20 either way, and that's really based on history and statistics. I can show you where a 90% stock portfolio has performed equally as well as a 100% stock portfolio over a long period of time with less risk. You get almost all the return with less risk than that. So by just adding another 10% to get to 20, it takes some risk off the table because you have events like COVID comes in, the stock market goes down 34% in 3 weeks in March. It gives you that little bit of void where you don't.
Okay.
Yeah.
That's when you're glad you have bonds.
Yeah, that's when you're glad you have a few bonds. And you as fiduciaries, I think this is certainly acceptable looking at a pension board and saying, okay, they realize what's going on with asset allocation. That's appropriate for this fund. Your fund has more in stocks than most pension funds when I'm looking at the big ones, $1 billion pension funds, all of them. And the reason for that is they've always been underinvested in stocks. And that's why there's a lot of pension funds in trouble across the country. they have too much money in bonds and other things, timber and those kind of things, and then they're just not, they just don't keep up.
Yeah.
So, of course, I guess you have a choice. We're kind of pushing you toward that end, but I think it's really good for you because this fund doesn't have a lot. Yeah, it's infinite, really, for us. And so it's got the longest, and we know stocks do 5% better than bonds over a long period of time. So you just kind of playing the statistics by keeping it. There will be times, we've been as low as probably since you've been on 60% stocks.
Yeah.
If interest rates were to get back to 6% or 5%, we would add the bonds.
Is there, are other pension funds, maybe smaller pension funds, do they more go a mutual fund route as opposed to like with us and you guys where we're buying, directly buying stocks and bonds instead of just kind of pooling the money?
That's hard to, a $15 million fund is that's a large, in the grand scheme of even across the country, that's a large fund. So I think the smaller ones, if you got down to below 10 or 5 million, probably would see more funds.
Yeah.
Doing that.
Have a more safe,
Because I was-
conservative approach.
I was just thinking if we ever did make the decision to do less than 20% bonds, I would feel more comfortable if there was kind of a middle ground. If we're gonna go below 20% bonds, have something in between the safety of bonds and the risk of stocks. And the first thing that came to my mind would be a mutual fund where it's still diversified between those two.
Yeah.
But it would be 100% from bonds to stocks. It would just be kind of diluted a little bit.
That's a good point to do that. And if you will, flip back over to page 4, and let me talk to you a little bit about your bond portfolio. Right. We buy both individual bonds and we buy bond exchange traded funds, like a mutual fund or ETF. And you can see that we've eked out a little higher rate of return than the bond market, really in every single period. And the reason that we've been able to do that is your bonds are not all just treasury bonds. A lot of them are corporate bonds. So they're issued by corporations. So they have a little bit of characteristic of a bond and a stock because they're a single corporation. And we talked about this last year, but one of the things we did when the stock market crashed in 2020 in the second quarter, you may remember this, there was a disconnect in the bond market, in that bond prices, corporate bonds tanked and they did it because they're companies and people didn't know what was going to happen. So we bought a lot of corporate bonds during that period. There was a really great opportunity, and we don't get very often in bonds, and it really helped performance. So I guess we're kind of doing what you're saying we're doing. We're investing in
Within the
bonds,
bond percentage.
but it's mostly corporate bonds.
Right.
And I can show you that if you flip over to page 11, 10 and 11.
So it's a bond that has a little bit of a higher earning potential than
A corporate bond is going to pay a higher rate of interest than a government bond because you're dependent on one company to pay you back instead of the taxing power. And I can give you a couple quick examples of bonds that we bought last quarter. Look down at that Apple bond, the third one under corporate bonds on page 10. The unit cost, we paid just a little over par, which means for $100,000, we paid $100,015 for it. Today, it's worth $109,000. So we bought that at a time when it was depressed irrationally. And there will be some others in here like that. On the next page, an energy bond is that way. Mercury General, we bought that at a discount. Some of them matured. One bond that we bought is this Murphy Oil bond. We bought it 95 cents on the dollar, currently trading at 104. And then Priceline, we paid 101 for it. It's worth 110 today. So you wouldn't have gotten that out of a regular treasury bond. We bought that because they were on fire sale. That was in the market. A really long answer to your short observation. And then you can see exchange traded funds on page 12 down there for the bottom. Intermediate government credit, Vanguard intermediate credit. Those are like a mutual fund. You're buying a basket of bonds. So those are not an individual bonds. The market's pulling, stock market's pulling back just a little bit. I'd really like to see it pull back some more. I think it could give us some opportunity. We like the stock market looking out a couple of years, the next couple of years. Companies should be doing really, really well. The market needs to take a look.
So I see that we've got some Heber Springs municipal bonds. Is that, and I think we've had maybe some Little Rock bonds before. On the Heber Springs side of that transaction, is that just like if we were to go out and sell bonds to do an aquatic center or something?
Exactly, except that these municipal bonds are taxable.
Okay.
They're not tax-free bonds. And so that's the reason that we bought those for the fund. There are certain, when you do one for, I don't know about for this one, aquatic center, I'm not sure you have to do some of it as taxable or you can do it all tax-free. But if it's for a purpose other than a municipal purpose, like it's economic development or whatever, it's going to be taxable.
Yeah. And we've done our HP bonds, we did
Oh, okay.
The HP bonds.
Yeah.
back in '08, they were taxable.
Mm-hmm.
So probably for the community aquatic center, that would be a purpose.
I would think so.
Wouldn't that would fit under the city?
I think it would.
Yeah.
Have you probably talked to bond council a little bit about that on the limited? Okay. That's all I have for that. Anything else? Good to see you. Appreciate your business.
Thanks for coming. Coming home early and going back or
I have to
saying?
go back today. It's all right. Most of the time I try to sneak away after this meeting, but it didn't work out today.
Thank you, Pat.
Here's a copy.
Yeah, I'll give that to you. Yeah, I texted him some pictures while he was talking. So I know Henry wants to hear
Yeah.
all that.
Do you know your way out?
Left.
Lady, let you know. You get mine. Sorry. We have many pension refunds this time. And the total amount's gonna be $91,647. We have one for Levi Hill in the amount of $19,160. Henry Marsh, $9,476. DeMarco Steiger, $6,762. William Nation, $7,134. Patrick Randall, $6,502. Amanda Van Pelt, $3,899. Michael Connors, $280. And then Richard and Andrew McClurg, $19,215.70 each. We had an employee, and I had a letter from the two gentlemen that I will read to you, addressed to the pension, the Employees Defined Benefit Pension Plan Administrative Committee. We are the sons and surviving beneficiaries of Tanya McClurg, who passed away on September 24th. We respectfully submit this letter as formal request to receive a distribution of all contributions that our father, Tommy McClurg, made to the city of Conway Defined Benefit Pension Plan. And they are the surviving beneficiaries. His wife passed away just before he did.
They're just asking for what he's put into it.
Just what he's put in. He was with the city almost 18 years.
And that's, I think y'all discussed this at the last meeting.
We discussed we were gonna have something like this come up. I don't think we mentioned the names, but we did discuss this at the last meeting. That's right, you weren't at the
Yeah, I
last
didn't
meeting.
know it was at the last one.
Yeah, we discussed it. And our document allows this. since they're a surviving beneficiary.
So I guess it really, just a curiosity matter of anything, there's nothing on our side that determines how they share that or split that, is there? We just give the refund and then that's up to them?
Since they're
So
censored.
split it
Yes.
evenly, so they're each getting a check equal amount.
Yeah, we're splitting it because they were his contingent beneficiaries under his
So we're gonna split it 50-50.
50/50. Conway has only 2 children,
Gotcha.
and they're not earners, so.
Do you need a
I
motion?
was gonna say, we need a motion,
we do.
motion. Pay out the funds.
Second.
Motion and second, all in favor?
Aye.
Motion carries. Does anyone, do we need to make a transfer to cover that amount?
Should not need to.
Okay. That's unusual for us to have that much money on it.
Right.
Does anybody else have any business today? We need a motion to adjourn.
Somebody.
Tyler?
Second.
Gary? All in favor?
Aye.
Aye. Motion carries 5-0. Meeting is adjourned. Thank you.
Thank you.
Thank you, Finley.
I talked to you.
Yes, sir. Sure. Yes, ma'am, thank you.
See you, Derek.
I got it.
What time did y'all get out last night? It was